Introduction to Investment Environment. We all know that investment is anything you buy with the expectation that it will increase in value. Now the question is, why is investing important? It is important because it is an alternate way to multiply your money. In this lesson, we will discuss the investment process, the key components of investment environment, investment versus speculation, investment versus gambling, and the financial instruments. After going through this presentation, you should be able to define investment, explain investment process, describe financial environment, understand investment, speculation, and gambling, define investment attributes and alternatives, explain types of investors, discuss financial instruments. Investment involves making of a sacrifice in the present in the hope of deriving future benefits. Investment is the commitment of money or capital to purchase financial instruments or other assets in order to gain profitable returns in the form of interest, income, or appreciation of the value of the instrument. A typical investment decision undergoes a 5-step procedure, which in turn forms the basis of the investment process. The objectives of an investor must be defined in terms of risk and return. The next step in formulating the investment policy of an investor would be the identification of categories of financial assets he would be interested in. Second step, that is security analysis, would consist of examining the risk-return characteristics of individual securities or groups of securities identified under step 1. Next is portfolio construction. This consists of identifying the specific securities in which to invest and determining the proportion of the investor's wealth to be invested in each. After portfolio construction, portfolio revision is important for better investment. The last step is portfolio performance evaluation. This step in the investment process acquires considerable significance since the tasks involved are quantitative measurement of actual risk and return their evaluation against objective norms. There are 3 elements of the investment environment. First is a financial market. It can be seen as primary and secondary. The primary market or the new issues market is an informal forum with national and even international boundaries. Second is financial instruments. It can be classified in different ways, such as money market instruments, which includes money market, treasury bills and commercial papers, etc., and capital market, which includes equity share, bond and debentures, etc. Third is financial intermediaries, which perform the intermediation function. That is, they bring the users of funds and the suppliers of funds together. Objective of investment depends on its specific objectives. Risk involved in investment is low and period of investment is long term. Its analysis is based on fundamental analysis and the return depends on the current income. An objective of speculation is only to gain high return. Risk involved in speculation is moderate to high and period of speculation is short term. Its analysis is based on technical analysis. The return is dependent on capital gain. Gambling is based on luck. Risk involved in gambling is high and period of speculation is short term. There is no analysis involved in it. The return depends on capital gain. Investment attributes are safety of principal, capital growth, tax benefits, concealability, and stability of income. The safety sought in investment is not absolute or complete. It rather implies protection against loss under reasonably likely conditions or variations. Capital appreciation has today become an important principle. To plan an investment program without regard to one's tax status may be costly to the investor. To be safe from social disorders, government confiscation, or unacceptable levels of taxation, property must be concealable and leave no record of income received from its use or sale. Stability of income must be looked at in different ways, just as was security of principal. Investment alternatives are equity, bonds and debentures, money market, real estate, precious objects, and insurance policies. There are various types of investors. The contrarian buys when the rest of the world sells. Trend followers are more conservative and tend to invest in products such as bank stocks. The last is the very conservative hedger and holder, which is the famous small investor of India who wants high return and low risk, preferably guaranteed by the government. Measured investors are secure in their financial situation and confident they will have a comfortable retirement. Reluctant investors are least likely to become overly attached to an investment or to put too much money into a single holding. Competitive investors enjoy investing, are informed, and try to beat the market. Unprepared investors, characterized as unhappy with their financial situation and lacking in confidence. Financial instruments can be categorized on the basis of the money market and the capital market. The money market can be defined as a market for short-term money and financial assets that are near substitutes for money. Call money is the money borrowed or lent on demand for a very short period. Treasury bills are first issued by the Indian government in 1917. Treasury bills are short-term financial instruments that are issued by the central bank of the country. Certificates of deposit are a negotiable money market instrument and issued in dematerialized form. Commercial paper (CP) is an unsecured money market instrument issued in the form of a promissory note. Commercial bills are basically negotiable instruments accepted by buyers for goods or services obtained by them on credit. Stocks and bonds are the two basic capital market instruments used in both the primary and secondary markets. Different capital market instruments are equity, bonds and debentures, and derivatives. Now let us check if we have understood the various concepts discussed in this lesson clearly. Notice money is lent for more than a day and up to 30 days. Right or wrong? Right. Treasury bills were first issued by the Indian government in 1917. Right or wrong? Right. Treasury bills have high yield. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied so far. Investment is anything you buy with the expectation that it will increase in value. Call money means money is borrowed or lent for a day. Portfolio management acquires an added significance in a dynamic investment environment. A number of specialized institutions are emerging. Many new and innovative instruments are opening up as investment alternatives. Commercial paper (CP) is an unsecured money market instrument issued in the form of a promissory note. When debentures are irredeemable, they are called perpetual. Originator is the entity whose receivable portfolio forms the basis for ABS issuance.